Welcome back to Plain Money, where we break down the biggest financial stories that affect your wallet. If you're new, we're all about making sense of money, markets, and the economic forces shaping our world. Make sure to hit that subscribe button and ring the bell so you don't miss our latest updates. Today, we're talking about something that sent shockwaves through the financial world. $7 trillion. Gone. In just 36 hours. We're witnessing the worst silver crash since 1921. And if you think this doesn't affect you, think again. This isn't just about precious metals traders or Wall Street hedge funds. This is about understanding what happens when markets spiral out of control and what it means for everyday investors like you and me. Let's set the scene. Silver has always been seen as a safe haven asset, right alongside gold. When the economy gets shaky, when inflation rises, when uncertainty grips the markets, investors traditionally flock to precious metals. Silver is often called the poor man's gold because it's more affordable but still holds intrinsic value. For decades, it's been a reliable store of wealth. But something unprecedented just happened. In the span of a single trading day and into the next, silver prices collapsed in a way we haven't seen in over a century. We're talking about a crash so severe that it wiped out $7 trillion in market value across commodity markets, mining stocks, and related financial instruments. To understand how catastrophic this is, we need to look at the numbers. Silver was trading at healthy levels, supported by strong industrial demand, fears about inflation, and geopolitical tensions. Then, without warning, the bottom fell out. Prices plummeted by more than 40% in those 36 hours. 40%. Imagine if your retirement account lost nearly half its value in a day and a half. That's the reality thousands of investors are facing right now. The last time we saw anything remotely close to this was in 1921, over 100 years ago. Back then, the world was recovering from World War I, economies were in chaos, and commodity markets were extremely volatile. But we're supposed to be living in modern times with circuit breakers, advanced risk management systems, and regulatory oversight. So what went wrong? Several factors converged to create this perfect storm. First, there was massive leverage in the silver market. Traders and institutional investors had borrowed heavily to amplify their positions, betting that silver prices would continue rising. When prices started to slip, margin calls came flooding in. For those unfamiliar, a margin call is when your broker demands you deposit more money because your leveraged position is losing value. If you can't meet that margin call, your position gets liquidated, forcing you to sell at whatever the current price is. This created a cascade effect. As positions were forcibly liquidated, it pushed prices even lower, triggering more margin calls, which led to more forced selling. It became a self-reinforcing downward spiral that accelerated with terrifying speed. The algorithmic trading systems that dominate modern markets only made things worse. These computer programs are designed to react to price movements in milliseconds, and when they detected the crash, they began selling automatically, adding fuel to the fire. Second, there were rumors of a major hedge fund collapse. While names haven't been officially confirmed, sources in the financial industry are pointing to a multi-billion-dollar fund that had enormous exposure to silver and related commodities. When that fund started unwinding its positions to avoid total bankruptcy, it dumped massive quantities of silver onto the market all at once. This wasn't an orderly exit. This was panic selling on an institutional scale. Third, and this is crucial, there appears to have been a liquidity crisis. In normal market conditions, there are always buyers and sellers. But in those critical hours, there simply weren't enough buyers to absorb the selling pressure. The bid-ask spreads, which measure the gap between what buyers are willing to pay and what sellers are asking, widened to unprecedented levels. At certain points, the market was essentially frozen because no one wanted to catch a falling knife. The human toll of this crash is staggering. Retail investors who thought they were protecting their savings by investing in a tangible asset have seen their portfolios decimated. Mining companies that were profitable just days ago are now facing bankruptcy because the price of silver has fallen below their production costs. Thousands of jobs in the mining sector are at risk. Small businesses that use silver for industrial purposes are scrambling to adjust their supply chains and pricing models. But here's what really concerns financial analysts. This crash didn't happen in isolation. Silver is deeply interconnected with other markets. Gold prices have also tumbled, though not as severely. Copper, platinum, and other industrial metals are feeling the pressure. The stock markets have been rattled, with mining stocks and commodity-focused funds posting some of their worst single-day performances in history. Even the bond markets are showing signs of stress as investors reassess risk across all asset classes. Some experts are calling this a canary in the coal mine, a warning sign of deeper problems in the global financial system. They point to the excessive leverage, the interconnectedness of modern markets, and the lack of true price discovery in an era dominated by algorithmic trading and central bank intervention. Others argue this is an isolated event specific to the silver market, and that panic is unwarranted. So what should everyday investors take away from this? First, diversification matters more than ever. If you had all your eggs in the silver basket, you're learning this lesson the hard way. Spreading your investments across different asset classes, sectors, and geographies is fundamental risk management. Second, be extremely cautious with leverage. Borrowing money to amplify your returns can work when markets go your way, but it can destroy you when they don't. Those margin calls we talked about turned what could have been temporary losses into permanent devastation for many traders. Third, understand what you're investing in. Silver isn't just a safe haven. It's also an industrial metal used in electronics, solar panels, and countless manufacturing processes. It's subject to supply and demand dynamics, speculation, and broader economic forces. Don't assume any investment is truly safe just because it's been around for thousands of years. Looking ahead, the question everyone's asking is whether this crash represents a buying opportunity or if there's more pain to come. Some contrarian investors are already stepping in, arguing that silver has been oversold and that prices will eventually recover. They point to the continued industrial demand, the role of silver in green energy technologies, and the long-term inflation concerns that haven't gone away. Others warn that we might be seeing a fundamental repricing of commodities in an era where economic growth is slowing and deflationary pressures are building despite what central banks have been telling us. They suggest staying on the sidelines until there's clear evidence that markets have stabilized. What's undeniable is that $7 trillion doesn't just evaporate without consequences. This crash will ripple through the economy in ways we're only beginning to understand. It will influence central bank policies, regulatory discussions about market structure, and investor psychology for years to come. For now, the silver market remains in turmoil. Volatility is still extreme, and no one can say with certainty where the bottom is. What we can say is that this historic crash serves as a reminder that in financial markets, fortunes can change in the blink of an eye, and nothing is ever truly safe. Thanks for watching Plain Money. If this video helped you understand what's happening in the markets, give it a thumbs up and share it with someone who needs to see it. Drop a comment below with your thoughts on this silver crash. Are you buying the dip or staying away? And don't forget to subscribe for more analysis on the financial stories that matter. Until next time, stay informed and stay smart with your money.